Dollar index, I still think we're range bound. I still like, I think this dollar could be like eerily sneaky. You know, I mean, I've said this before, this is kind of repeat analysis, but right now we have interim levels right here. Either this 108 handle holds or this 105.50 level holds. Like 105.50 is my break to the downside. If we're not going to break that, if we're greater than 105.50, I'm still bullish on the dollar. Okay, 108 is a potential resistance point, but if that breaks through, we come all the way back up towards this 109 plus handle, we might hit a round number at 110. This is the surprising move. If we get all the way back to 114, that's a really surprising move. Okay, just look at it this way. This low, okay, and we took out all these highs. If this is in any way, shape, or form giving us some type of bullish pattern, don't be surprised if this market measures this move and gets us back up to this 113, 114 handle. As I said before, this is very disruptive in the Forex market. If we see another, let's say 700 points on the DXY, and that translates into pips. If you've got a 700 pip move on the euro, we're going back below parity, right? If you've got a 700 pip move in the Aussie, New Zealand, you're going to be at like 15 to 20 year lows. We're going to go to like post-Brexit flash crash levels on the pound US dollar. If we get a 700 point move on the DXY, it's going to be crazy. The only thing that might be different and non-correlated might be the dollar yen, because the BOJ does whatever they want. But if this happens, that would be extremely disruptive to the Forex market, where look, it's a flow that I wouldn't want to fight, but it would be ultimately a fantastic way to then, you know, have some short-term strength in the dollar. You can ride that thing out as long as necessary, and then if we find a topping pattern, short the living heck out of the dollar and make a fortune. You know, and that's usually how I trade. It's like, I might not get this area where I'm super aggressive and active because I don't like it. But if we start trading into open space where this is a big resistance level and we've taken out and we swept all these recent highs, if all this is, okay, is a buildup and another accumulation zone for this dollar to go higher, okay, we could turn this into like a three-wave move. This could be 1, 2, 3, 4, 5. This could be a five-wave move to finish this thing out. I don't know. But when this is done, I'm looking at probably an easy ABC correction, sell the heck out of the dollar, make a fortune. You know, if we get a three-wave move, there's going to be plenty of opportunity to be long the dollar if it's proving to get, I don't know, looking to build off like 105.50. If we find support at 105.50 multiple times, you know, you can stack up your breakouts, you can get proven to be right, and then see price go up. But don't be surprised to see dollar strength. Just saying. Okay. Have you noticed that the yen, I mean, yeah, but who cares? I mean, does anybody trade the yen and make money? So, I mean, these last couple of weeks, I mean, here's the best way I trade the yen. This is the only trade I'm going to take in the Japanese yen. I'm not touching the currency market for the Japanese yen. I will take defined risk all day, and I'll trade it in the Japanese yen futures. So if we come back down into these lows, I will be looking at a long position on Japanese yen futures. Right? And why would I do that? Because I can do defined risk trades. Here's what I like about it. If I trade options on Japanese yen futures, I can get in around this area where I would say technically I'd like to be in. And this Japanese yen can get super weak or it can get super strong. I can define my dollars and percents here and take a trade. This is way better for me than trading the Forex market, because the Forex market will test these highs and lows, and it's going to run these liquidity levels, and it's going to be super messy. It's going to take months and months to play out, and eventually you get a move. But if you get beat up and you can't survive that, you're going to get your butt kicked. So I can place a trade with no stop loss. I can just trade defined risk options, and this thing can go down to zero, and the Bank of Japan can have a currency that goes to zero. Or this thing can go up and be the strongest currency pair in the world, and I'm only going to risk the same dollar and percent that I put on the trade originally. I am totally fine with that. So I get the ability to truly define my risk, and this asset can be way off, price-wise higher, price-wise lower, and I'm not risking any more than what I predetermine in the trade. So that is the only trade that I'm interested in on the Japanese yen. It's going to be a futures trade, and if it comes back down to these levels where we saw some deleveraging back in July and August, then I'll take another stab at it, right? And what's my timeline? I probably go out 6 to 12 months. And hope that I'm right, you know, and maybe I can say 3 to 6 months and try to be right there. I also, I mean, if I could trade like micro Japanese yen futures, which I don't know if there is that. Let me see if there is a micro Japanese yen. I don't think there is. MNQ, no, that's not it. 6J, I don't think there is. I don't think we have any micro currency futures. /MJ, nope. 6. Okay. Micro Aussie, micro pound, micro euro. Son of a bee. I don't have micro Japanese yen. Crap. So I've got micro Aussie, euro, and pound. That's fine. It's probably, I don't know. I was going to say, like, it would be a better trade for me to trade a micro Japanese yen and trade a long put. Or I'm sorry, trade a long call. And the most I can lose is what I pay for that. So if I paid, let's say, $250, right? Here's an example. If I got in here for a defined risk of $250 and this thing went up like it did during that July, August volatility event, that would probably pay, I would say, $2,000 or more. That type of move and that type of volatility, you would turn this into a monster winner. But if I do it defined risk, then the expiration comes into play and I've got to time it out. But, if I technically get a bottom, I'll be fine. I just wish there was a better way to trade that doesn't cost an arm and a leg. So if I did, I'm just going to look at it right now. If I just did /6J. Okay. And I look at something, I'll just say March of 2025. If I buy an at the money put, if I buy an at the money call or one strike out, I mean, I've got to risk $1,500 on a futures contract. Now that's the most I can lose, but can you see why I'd want to go define risk? Just like that, I can make $375 to risk $220, like or $250 to make $375. Like automatically with defined risk, I can make it so, maybe I get like 125, 130% return on capital. But now I have to play it out with like the timing has to be right. And that has always been like the hardest thing to do in the Japanese yen is time this crap. Because who knows? So we'll see. It is what it is. Could I trade this another way? Let's see. I could do a zebra, which would be super expensive. If I bought 2 contracts here and I sell a 50 delta right here. So the 6.6, I'm going to sell one of those. So this is essentially like being long the contract. I mean, I'm risking $4,000 on that trade. It's like, it's not worth it. I'm not taking that type of risk on the Japanese yen. So we'll see. Defined risk is probably the style. But to me, that's just way more flexibility than it would be if I just traded Forex. Because Forex, for the Japanese yen, my least favorite currency pair of all time.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.